For question 4.1, before estimating the regression, we subtract RF, which is the risk-free rate given in the last column, from both the RI and the RM columns. The estimates are beta, which is 0.878, and alpha, which is 0.07%. To compute the cost of capital, we combine our estimates of beta with the market premium of 7% and the risk-free rate of 4% and get the result of 10% of cost of capital. For question 4.2, we are uncertain about this statement because according to the Pastor-Stamble model, we are not sure whether the beta of size, value, and liquidity is positive or negative. Therefore, we cannot conclude if the stages of venture capital investing are positively or negatively related to the expected return. However, we do find some data showing that on average, venture capital requires a return between 36% to 45% for early stage investments and between 26% and 30% for expansion later stage investment. These data indicates that in an uncertain decision-making environment, venture capitalists investing in early-stage firms might confront with occurrence of an unexpected adverse event, which is riskier.
It will replace a public company. First of all, if all companies were to replace debt for equity on a scale that private equity firms have, the cost of debt would increase. This will lead to superior equity returns hard to achieve. And secondly, private equity firms need an exit route. Even with a growing trend for secondary deals, there must be a limit for further efficiencies of secondary market. Therefore, the public market will need it for someone to realize the profit. And thirdly, a bigger role for private equity might make the economy more vulnerable. In a in a world where most companies carry private equity style debt levels, companies will be much more vulnerable and recessions might become much more frequent. For question 6.2, we think the answer is false. We disagree with the statement. According to Chapter 6 in DLS research, the 21 countries with English common law systems, including Singapore, India, and Israel, Hong Kong, and South Africa, have an average self-dealing index of 0.67. Apart from these 21 countries, all other nations in this research with their legal origins to several codes of ancient Rome have the average self-dealing index of 0.37. That is to say, such common law-based countries tend to provide more protection to mandatory investors.